it was an economy of illegal immigrants and government jobs, while the private sector was losing jobs and people were struggling. I don't know if anyone's watched the Hunger Games. The capital city was where all the wealth accrued, and it looks like our tax dollars were being used to fund our own destruction. And a lot of these people were getting filthy rich doing nothing, and now the jig is up and they have to sell their homes, or maybe there's also stories that Google searches of non-extradition country. I mean, this is insane what's going on. So this is happening fast. The bad news is you're going to find all this fraud. You're going to pull away the stimulus that was there. It's going to cause a contraction in the economy. We have a tech bubble. That's going to unwind. We're going to have a mini housing crisis. That's just in the cards. In the great financial crisis, there were smart people who were figuring out what was coming. Right now, the stock market doesn't have really humans running the show. There is a chance that the stock market is so disconnected from reality that when it does figure out reality, it could happen faster than we could imagine. That's kind of the scary outcome, is that everyone heads to the exits at once. We've had this bizarro economy where the very, very poor and illegal have benefited, the very rich have benefited, and the whole in between is suffering mightily. And that is why Trump was primarily elected. I think there's a hope in the Trump administration that they're going to, because Trump is in there, everything's going to take off. And I know how the real world works, and it takes time for these measures to get into the economy. We've had this very odd jobs data going on. There's two schools of thought: abject bureaucratic incompetence, or fraud, or a combination of the two. The BLS, which is our Bureau of Labor Statistics, reported a revision in March of 2024 prior year of 600,000 jobs to the downside. That's a 4 to 5 standard deviation error. A 3.4 standard deviation event is the chance of lightning hitting you at least once in your lifetime. That is not normal. Then there's the quarterly census of earnings and wages, also done by the BLS. The first one has surveyed 600,000. The other one is 16 million by law. So this is estimate, this is reality. It was a 7 standard deviation difference from the non-farm payroll, or the estimate. The biggest one we've ever seen, a 5 to 10 standard deviation event, is the chance of your mom giving birth to a 9-foot giant. And so again, what's going on?
In 2023, the blogosphere was filled with economists predicting an imminent recession. After all, there was no way the economy could afford 5% interest rates after decades of monetary stimulus. But the recession never came. My guest today went back to find out what happened, and his analysis led him to the conclusion that the recession wasn't avoided, but delayed. Ed Dowd is a founding partner of Phinance Technologies. His new report warns of the danger of a deep worldwide recession in 2025. Why now? Radical shifts in government policy in the US and Europe mean that the phantom recession of 2023 is about to burst onto the stage with a vengeance. Ed, thanks very much for coming on all the way from Hawaii.
Nikolai, great to have me today.
Okay, well, let's start with who you are and what Phinance Technologies is, because really what we're focusing on here is this report that you've put out, but also the predictions you made back in 2022 or 2023. So give us the context for why you're the one coming on to tell us about this.
Yeah, so Phinance Technologies, I'm an ex-Wall Street executive. I've worked at HSBC in fixed income, Donaldson Lufkin and Genred in equity research, and most notably BlackRock. For 10 years as a large cap growth portfolio manager, we managed $14 billion. So I have extensive experience in the capital markets. And the Phinance Technologies came together when we were investigating the phenomenon of excess deaths and the rise in disabilities during COVID. We came to some conclusions that a lot of people are not particularly happy with, but that's our opinion. We've now rejiggered our focus on the economy. We were always doing economic work. My partner, Carlos Alegria, worked at a number of hedge funds. He's based in Portugal. He worked in the equivalent of the Glitterati, Winton Capital, and other notable hedge funds. He wrote a book, Economic Cycles, Debt and Demographics, and that's what we do, economic research. We're looking to start a hedge fund eventually once we find a seed investor. And in 2023, we have economic cycle or early cycle indicators, and a lot of other economists saw the same thing. We're heading into a recession after the Federal Reserve pulled the brakes and raised interest rates from 0 to 5%. We had some bank failures in 23. People don't remember them much anymore, but they were big. And money supply was rolling over. It was negative year-over-year growth. So we called a recession for the end of 23, beginning of 24, and it never materialized. So having looked at our economic cycle indicators, we determined that one of two things happened. We are experiencing a new law in the phenomenon of economic cycles. They've changed. The old rules are gone, or there's something else. And we just recently issued a report that kind of went back and identified what was new and how it's all going away in the next couple of years. And it's going to bring the recession that was delayed forward with a bigger hangover, unfortunately.
So tell me a bit more about why you were confident enough to call a recession in 2023. What were the indicators that you were looking at? And I'm assuming they had a good track record of predicting things in the past.
Yeah, so we can't reveal what those indicators are because it's our secret sauce. It's part of our hedge fund magic. But they're all real fundamental economic leading indicators that are based off of large government databases. We look in curious places that no one really looks at, so that's why we can't reveal them. But the cycles had been dead spot on for years, and even back testing the data, they'd worked for decades and decades. So to get one that wrong, along with other economists that use different methods as well, we had to ask ourselves what went wrong, and the answer is something that we can discuss here, and it's in our U.S. economic report in a very detailed fashion that is available for purchase. The target audience is high net worth individuals, family offices, asset managers, CEOs, CFOs that have businesses that might be affected by what's coming.
Yeah, well, the crucial thing here is that it's two topics or two causes that are reversing right now. Yeah, so just as the recession didn't occur in the last 2 years, your reason for predicting why one will occur in 2025 or why there is a risk of one occurring in 2025, they're the same reasons, right? Which is what makes this so intriguing. So take us through why we didn't get a recession in 2023, 2024. Well,
something happened. There was a new economic variable, two economic variables, but the big elephant in the room is illegal immigration. We imported into the U.S. in 4 years, 10 million officially reported, but it could be, some people could have snuck through. So let's call it 10 to 15 million. Our analysis is based off of 10, but it's probably likely higher. And that to give you an idea of what normal legal immigration is in the U.S., it's 1 million a year. And when you import that many people that quickly, and it's starting to come out, and we suspect it, and we believe we're going to be correct. There's a whole daisy chain of economic activity for every human that comes across the border. It's not just the direct government stimulation that they got in the terms of, free credit cards and accommodation. There's a whole NGO network, which is being exposed as we speak, of billions and billions, perhaps trillions of dollars that were paid out to facilitate someone coming from Central America. There was money that had to be doled out to get them from Central America to the Mexican border. Then they had to get them across, and they had to fly them or transport them into the interior of the U.S. This wasn't just a Texas phenomenon on the border. These people were sometimes, there's been reports now coming out from the new Homeland Security chief that 700,000 people were transported via private jet by the government, footed by the government. That's just 700,000. So So let's just assume let's do some reasonable characteristic tests here. Let's assume to get someone from Central America, situated in the U.S., set up in accommodations with NGOs employed to facilitate this, the all-in economic cost of one human being getting in here could have been $50,000 to $100,000. Let's go to the high end. The high end is $100,000 on just $10 million alone. That's $1 trillion of money that went into bringing these illegals over. That is a phenomenal amount of money. Let's reasonable test this. Let's call it 500 billion to 1.5 trillion, because maybe 15 million. So there's a range. 500 billion to 1.5 trillion was spent to get these people into the U.S. economy. The other thing to know about immigrants, illegal immigrants, is you give them money, they don't hold on to the money for very long, and they spend it right away, thereby supporting consumer goods and retail stores and supporting the housing market, because they were renters mostly, and their rent many times was often paid for by charities and or the government directly. So that is a huge, huge economic variable that, stimulated the economy for a short time frame. It's also interesting to note that the U.S. ran what we call crisis level deficits for 2 years. 2 years.
Hold on, Ed. Let's discuss the immigration in a bit more detail before we get to the fiscal one, because it's so unbelievable.
Well, no, it's linked. It's linked. That's why part of the reason we ran deficits is to pay for these illegals.
Yeah, agreed. But I want to at least get in a mention here of something that is fascinating, which is the way illegal immigrants show up in US job data and economic data is kind of odd, right? Because they show up in some ways like their consumption, but they don't show up necessarily in jobs data in quite the way people might expect. And this is why your focus is on illegal immigrants in the US, because the economic statistics to cover that are kind of a bit odd. They deal with illegal immigration in a kind of an odd way. Whereas in the UK, the big issue has been just the amount of legal immigration. But it's a similar economic effect, right? But take us through the statistical quirks of US job and economic data when it comes to illegal immigration, because this is one of the reasons why the recession was so difficult to pick.
Well, so there's two things going. There's two surveys that everyone pays attention to. Most of the capital markets pay attention to what's called the establishment survey, which is the monthly jobs data, right? That's the official estimate. It's an estimate. It's a monthly estimate that then eventually, and it's a survey done by our Department of Bureau of Labor and Statistics. You probably have an equivalent in the UK. But so that these people do a survey of 600,000 employers, and then they use statistical birth death rate models, and they come up with an estimate. The estimate eventually is codified into reality on a very large lag when they get all the data from the 16 million actual employers that pay salaries and wages and tell who they hired or fired. So we've had this very odd jobs data going on for much of the beginning around June of 23, going into 24, where there was continued growth in the establishment surveys, but the household survey, which is, legal people, was going sideways, which showed a problem. And if you want to ask why Donald Trump was elected, there was a problem in the middle class. They were in a recession. And the real wage growth was minus 2% going into the election. So the middle class was already in a recession. And this phenomenon has a historical precedence. In 1980, when Ronald Reagan was elected, he had minus 2% real wage growth, and he was swept in an electoral mass victory and popular vote. Same thing happened with Bill Clinton in 92, minus 2% real wages, where James Carville said famously, "It's the economy, stupid." So we really had kind of this bizarro economy that on paper looked good. The GDP came in, but small businesses were struggling. The average consumer was struggling. Real wage growth was going down. What was going on? Well, the mystery was solved last payroll report in the U.S., the last jobs data report. They trued up the household survey by 2.2 million individuals in 1 month. And now it's the same as the and in our report, we're going to take credit for this. In our report, we assumed that not all of these illegal aliens got jobs. We assumed conservatively 20%, and sure enough, that's the number. So we accurately predicted. And these jobs are very low wage. They're not jobs that can really support an economy. So what we have now. The policy is not that. So that whole immigration policy is absolutely reversing, and it's happened quickly. The border contacts, there was
Hold on, Ed. Let's get to the reversal later once we've explained the fiscal side that happened in 2023. But first, I want to set the context here for viewers in the UK and Australia, actually, because Australia is in a severe per capita recession. The UK is in a per capita recession, but neither of the countries are in an official recession. And the difference is the immigration rates. And what I think you're saying here in the US, what happened is that they goosed the statistics by allowing vast amounts of illegal immigrants in, so that your per capita data is looking pretty good because you haven't accounted for the fact that there's all these millions of people that have flooded in. So I think it's a really intuitively easy thing to understand for those who have become aware of this divergence between overall GDP statistics and GDP per capita recessions.
Correct. And so we've had this bizarro economy where the very, very poor and illegal have benefited, the very rich have benefited, and the whole in between is suffering mightily. And that is why Trump was primarily elected.
Okay, so let's go to the fiscal side now. Obviously, as you said, it is connected because there's a lot of fiscal support for the illegal immigrants, ironically enough. Take us through how much of an impact that side had.
So the deficits we ran in 23 and 24 were basically 8% to GDP. To give your viewers a historical context, the Great Financial Crisis, it was a crisis, mind you, and World War II was a crisis. We were running World War II and COVID-like and great financial crises during the election year of 8%. So what was the crisis? The crisis was to get that administration elected and to change the face of the U.S. to make them more favorable towards the Democrats who favor illegal immigration.
It was a pandemic. It was a pandemic of Trump derangement syndrome, right?
All that too. And so in addition to the illegal immigrants, which I said we don't have the exact numbers, but I'm assuming there's anywhere from 500 billion to 1.5 trillion to get these people in here. The all-in economic cost, not what they got directly, but the all-in economic, and that economic cost creates economic activity, which boosts GDP. So we borrowed against the future to bring in replacements illegally. That's what they are. They're replacement workers. And we also had unprecedented government hiring. So it was an economy of illegal immigrants and government jobs that really floated the jobs data, while the private sector was losing jobs and people were struggling that actually produce and do things and work for a living and drive trucks and farm and create things. Those people weren't doing so well.
And this is a global phenomenon for governments and countries all around the world. So in Italy, for example, they had massive deficits despite the fact that there was no proper recession. In Australia and the UK, it's an immigration story primarily. In the US, it's the illegal immigration and the size of the fiscal deficits. And your point in this report is that if we take these two tailwinds to economic growth and GDP, which were used by politicians to avoid a recession in 2023, they are now reversing. We've got crackdowns on immigration, and we've got huge amounts of cuts to government, wasteful government spending, the Republicans would argue. So take us through what's going on now to reverse those two trends.
So there was immediately upon Trump winning the election, there were stories of mass self-deportations. I guess they thought the gravy train was over, so they left. And so we were curious to see, well, has that had an impact yet? And sure enough, it has. It's already had an impact on something we call new tenant rents. We had a follow-up mini report to our big report that's available to the subscribers for basically free. Say, hey, our thesis looks like it's starting to germinate. Basically, new tenant rents are a leading indicator for all tenant rents, which are a leading indicator for home prices. New tenant rents plunged in the fourth quarter. Plunged. So now it's a volatile series. It's done quarterly, so some of that may reverse out, but we don't think it's still going to show a trend of heading down. It actually started to head down a little bit before the election, but it really took a plunge in the month of December. So we're seeing that. Then we also know what's going on with border encounters. I think it was a huge amount under the Biden administration, and now it's dropped precipitously. There's also a simultaneous effort by Doge, the Department of Government Efficiency, headed up by Elon Musk under the approval of Donald Trump. That's basically, I'm actually shocked at how quickly they're doing what they're doing. So I thought this would take more time. I thought it was going to be a new government agency. It'd have to be funded. It'd have to go through Congress. I thought this was going to be just kind of a slow roll. The clever thing they did is they used an old program under Obama called U.S. Digital Services. It's already funded. It already has the legal writing in place to do what they're doing. This government. So they rebranded that government program as Doge, and it's already funded, and it gives them access. Excuse me, gives them access to all the IT infrastructure in every department. So they're already finding things, shutting off the payments, and this is and there's also stories going around that DC home prices are plummeting. Apparently, people are listing homes quickly.
Explain why that's significant.
Well, it's because I don't know if anyone's watched the Hunger Games abroad, but the capital city was where all the wealth accrued, and it looks like our tax dollars were being used to fund our own destruction. And a lot of these people were getting filthy rich doing nothing, and now the jig is up, and they have to sell their homes, or maybe there's also stories that Google searches of non-extradition country. I mean, this is insane what's going on. So this is happening fast. And so when you had an economy that was floated, and by the way, what's being reversed couldn't go on much longer. You can't have $2 trillion deficits ad infinitum. This is going on in Europe and other countries, but the U.S. finally started doing what I call fiscal dominance, where the government is the only game in town. And for the last 2 years, that's what it was. This is all going the other way, and it's happening quicker than I thought. And so what's the bad news is you're going to find all this fraud. You're going to pull away this stimulus that was there. It's going to cause a contraction in the economy. But then eventually that wasteful capital that was crowding out private investment it's going to mean eventually lower taxes, lower regulation. So there's going to be a temporary valley before, the recovery comes. And the severity of it, we don't know yet. And it depends on a couple things. It depends on Trump getting his initiatives through, his tax cuts, his deregulation. Does the new business environment get what we call animal spirits and generates a lot of activity? That we can't predict. But what I can tell you is there's going to be some pain that we put off. And then, if you're prepared for it and have a lot of opportunity as well. I don't view recessions as something to fear. I view them as lots of opportunities. And hopefully on the other side, we're crawling out of this. The problem for the Trump administration is going to be they're going to blame all his policies on the recession, and it's going to be a battle of the marginal mind. So the way I'd frame this is we're going to have a recession because the economy was fake and stimulated with things that weren't good for us long term, like societal breakdowns from, illegal immigration, extra expenses to accommodate these people that don't really add to the economy. They only add in that we print money, create debt, and then drive it back in through them. Long term, this is going to be good. And the Trump administration needs to basically frame it this way. If you don't see a recession, we're not doing our job in restructuring the economy. Because if they continue the government spending at the pace we've been going at, it's new boss is the same as the old boss.
Yeah, there's a quirk in all of this in how we measure economic activity. It includes government waste. So if you cut government waste, you get a recession. I want to quickly mention before we continue, one of your predictions here is that this is unlikely to devolve into a financial crisis because what we're doing is cutting waste and cutting immigration. We're not having a mortgage crisis or a tech bubble, whatever it might be. We're cutting things that we shouldn't be doing. So you're not predicting a 2008 style crash, are you?
Well, we have a tech bubble that's going to unwind. We're going to have a mini housing crisis. That's just in the cards. Does it go systemic? We don't think so. We think what we need to watch is the policy responses when this becomes apparent to everybody. There'll be two things. There'll be a monetary response from the Federal Reserve, and then there'll be a fiscal response from the Trump administration. If it goes systemic, Katie, bar the door. That's lights out. But we're not predicting that. We think it'll get serious. It'll be scary. The stock market will go down when it goes down. I mean, the last two times we had problems in the tech bubble in the U.S. and the great financial crisis, the stock market went down 50% both times. So it's not the end of the world. And it's an opportunity for people that, feel like they've been priced out of younger people, priced out of the housing market and priced out of the stock market. It's a good time to get in. The biggest risk to anybody in any kind of recession is losing their job. And so my advice to anybody that's in a job right now, make yourself as useful as possible to your boss as you can. Make it so that you are someone they can let go in a downturn.
And you'd see that as a buying opportunity if the market does go down that much, because unlike the 2003 fake boom, the boom that we would be experiencing this time around would be one of moving away from waste and towards productive enterprise and investments. Well,
it'll be different. I can't tell you what sectors of the economy are going to take off. What I can tell you is that the AI bubble reminds me of the .com bubble. It's a similar phenomenon. There was a lot of companies that went to zero. They were fake companies, but the companies that really benefited were Cisco, Qualcomm, Nortel. These were the bubble stocks, and they benefited from what we call a bandwidth infrastructure boom. And all those companies that built that infrastructure went bankrupt. The infrastructure didn't disappear. So the same thing's going on with AI. We're building all these data centers. We're funding all these companies. There's no revenues on the other side. So these companies will go bankrupt. And then there'll be all these, the chips that cost, the NVIDIA chips that cost $40,000 per GPU will be, selling for $1 or $2, and people will buy them up. And that's when we get the real AI boom. Just like we had, the Web 2.0 was born out of the ashes of the .com bust. Bubbles aren't necessarily bad. They create a phenomenon of excitement and dreaming. There's overinvestment, overcapitalization of the sector. It goes bankrupt, but then you have the infrastructure that remains, and it creates a boon to the economy eventually. For instance, there was a railroad boom, infrastructure boom in the 1840s. All those companies went bankrupt, but they built the railroads, and then there was cheap pricing, and the economy flourished. So I think with barring a systemic crisis, the recovery coming out the other side will be great. I think it'll be, and I think as long as Trump is able to, get done what he wants to get done. There's some global issues. I mean, we don't want a World War III to start. We don't want this Ukraine situation to get out of control. Apparently, Europe is throwing a hissy fit right now and going to stand up against Trump and, continue to do the grift that they're doing there. I mean, the European Union is a giant grift, in my humble opinion.
Isn't it bizarre that it required Trump for Europe to rearm instead of the invasion of Ukraine and by Russia? But let's not go there. Let's talk about what else you're expecting to be part of this recession. Does it solve the inflation problem? Does it mean bonds are bid back up? Is Trump going to be forced to come up with some fiscal stimulus of his own, given midterm elections will be coming up? How does the central bank react? How does the Federal Reserve react?
The central bank is going to the central bank's going to print. So inflation is going to temporarily go away because the way the money system works, you create inflation through creating credit. I mean, printing money and putting it on your ledger does nothing. It has to get transmitted out into the economy. That's through debt creation. And so basically, COVID was a super inflationary event that reinflated the whole globe. And in fact, I would contend that we were going to go into a global financial crisis in 2019, but COVID mysteriously saved it. It allowed governments excuses to print unprecedented amounts of money, inject it into their economies, and unfortunately, it created inflation right away. The Federal Reserve raised interest rates from 0 to 5%, took the punch bowl away. Then we had fiscal dominance that temporarily, kept inflation high. But I just told you, new tenant rents are starting to drop, which will lead to home price drops eventually, and the shelter. Shelter is a big part of our CPI inflation measurement. We think just if that goes the direction we think it's going, inflation will be sub 2% by the fall in the U.S. And so disinflation and deflation are not good for bankers. So there'll be a recession, and then we go through this whole merry-go-round again. That's why the system eventually needs to change. The Fed will print. There'll be fiscal emergency stimulus, and then we'll have inflation again. So it's a deflation-inflation roller coaster as the system is kind of nearing the end of its usefulness. And I can't predict when we're going to have a new system. It just needs to be done at some point.
I believe Fed Chair Powell recently said that he won't turn to QE until rates hit zero. So where are you sort of sitting on that spectrum of are rates going to get to zero and will there be QE?
Well, if I'm him, I don't want to do QE, but he may be forced to, depending if it goes systemic. If it doesn't go systemic, and Trump can do this very nimble dance and reinvigorate the economy, we may not need it. It's possible, but I do think interest rates are currently 450 to 475 in the U.S., and I think they're going a lot lower as we roll through the year.
It's an interesting claim because obviously it feels like there's a lot of bearishness on bonds around.
That's the wrong call. That everybody. I'm a contrarian, and the time is nigh for that call to go completely the other way. It's been a horrible stretch of history for bond returns, one of the worst in the last 80 years. And if you're going to take away all this juice, that is not going to cause bond yields to go up, especially if the Trump administration and Doge show their commitment to cutting waste. The bond market will eventually figure this out and start discounting lower yields. And I don't know if you saw this, but of course, financial magazine covers are always a signal to go the other way. Barron's, which is a very well-followed financial weekend newspaper magazine, put out on the cover several weeks ago, "The Trump Economy. Stay in stocks, avoid bonds."
Yeah, it's the ultimate irony again. You've taken me through stocks, bonds. What are you doing? Is it a combination of bonds and then anticipating central bank?
We don't give investment advice. We're not going to do that. And it's in our report. We give some recommendations to some of the people who purchase our report, but we're not about giving specific ratios and we're not giving financial advice over the air.
Understood. We're not allowed to anyway. Tell us about how to get your report then.
Our report's available at phinancetechnologies.com. It's spelled with a PH. It's not a cheap report, but again, those of you who have been watching, the one investment recommendation I can make is if you have a 401k or a pension fund where you have access to change your allocation, do what Warren Buffett's doing. Raise a little cash. We call it dry powder. Dry powder gives you the ability to buy low rather than your whole portfolio going down. You have some powder to buy at lower prices. That's what Warren Buffett has got the largest cash holdings he's ever had. He started this about 2 years ago. He was early like us because he probably saw the same things, but he's not changing his stance, and he's not reinvesting into the market at these all-time valuations. The valuations for the stock market are really unprecedentedly high. It's just like the dot-com boom. And, buyer beware. Usually when we get to these valuations, the forward 10-year returns are subpar.
There's two more follow-up questions I want to ask you, Ed, pretty much for my own benefit here, as much as the audience's. It feels like the way that GDP statistics and economic statistics generally are calculated really disadvantages someone like Trump, who wants to cut waste and sort of realign the economy towards less wasteful spending and more positive investment that leads to genuine economic growth. Would you agree with that? Do you think that there's something inherently wrong here, or am I sort of reading into it a bit too much?
Well, back in the day, when fiscal dominance wasn't a problem, I mean, when I was, in the 80s and 90s, the government spending was always part of the economic GDP numbers, but it was 15% of the total economy. So the real driver was private industry. Fast forward to COVID. Now it's come off a bit, but during COVID, the government was 43% of our economy. I think it's in the 30s now, but it is literally fiscal dominance. And so we're in a kind of a unique period of history where normally Trump wouldn't have to worry about this. But now I think the fact that we have something called fiscal dominance, there needs to be a communication strategy by his team as to what he's doing, what's going to happen, and why it's long-term beneficial. I haven't seen that yet. I think there's a hope in the Trump administration that they're going to, because Trump is in there, everything's going to take off. And I know how the real world works, and it takes time for these measures to get into the economy, whereas what he's doing now is having massive impacts immediately.
And like you said, there's historical precedent for this with Reagan, Thatcher, and the one I'd mention is the Australian Prime Minister Paul Keating in the 90s. He's a centre-left Prime Minister. He famously had the recession we had to have. That's how he sold it to the electorate, and he did fine politically despite this recession. So I think
that's brilliant. That's brilliant, and I think that's what maybe you've heard something I haven't, but I'm not hearing the Trump administration doing that yet.
No, and this is what makes interviewing you so interesting, is you're fairly supportive of what Trump's doing on the fiscal side so far, at least, or what he says he's going to do, and yet you think it's going to have this negative outcome on GDP initially, which is what you think investors should be preparing for. The second follow-up question is that economic data, just generally speaking, you've focused on the employment data because of illegal immigration. There's also been some issues in the UK on how some of the GDP statistics are collected and the declining response rates of surveys that the Office of National Statistics uses to calculate GDP figures and other things. Do you think there's a bit of a breakdown happening in these large government databases and how they calculate things sort of remaining the same as the economy completely changes over time as the importance of illegal immigrants spikes in the US? Do you think we're sort of in an economic data and statistics crisis of some sort?
Yeah, so I've talked to a couple other economists privately, and we think, so there's two schools of thought: abject bureaucratic incompetence or fraud, or a combination of the two. Yeah. Let's just go with bureaucratic incompetence. There's something that's like again, the illegal immigration, the elephant in the room. There's these statistical anomalies we're seeing in the jobs data that's, the forward estimate that's reported every month versus what the historical follow-up reality is. So in the last jobs report, the BLS, which is our Bureau of Labor Statistics, reported a revision in March to the March of 2024 prior year of 600,000 jobs to the downside. That's a 4 to 5 standard deviation error. That is not normal. That's not normal. Okay, let's just get that out there. I'm going to go into a little bit of wonky stuff, but I think your audience will understand. So like I explained, we have the estimate jobs data every month followed up by reality. Well, there's something there. So there's in the U.S. there's the non-farm payroll, which is the estimate done by the BLS. Then there's the quarterly census of earnings and wages, also done by the BLS. The first one surveys 600,000. The other one is 16 million by law. So like this is estimate, this is reality. Now the reality report takes a while to get all the data, and it's reported on a lag. The last one that came out in the U.S. was June of 2023. It was a 7 standard deviation difference from the non-farm payroll or the estimate, the biggest one we've ever seen. And so again, what's going on? And by the way, that number translated into 1.25 million jobs to the downside difference.
I'm just going to calculate here how rare a 7 standard deviation is supposed to be.
While you're doing that, a 3.4 standard deviation event is the chance of lightning hitting you at least once in your lifetime. A 5 to 10 standard deviation event is the chance of your mom giving birth to a 9-foot giant.
All right, I think you've done a better job of what I'm going to say then. Right. So, how do you invest in an environment when, you can be right about everything that's going to happen, but the economic statistics, possibly because of incompetence, possibly because of the political motivations, just go 7 standard deviations out, and the market moves based on the statistics, right?
The market moves based on the estimates, not the book report, not the follow-up data. Well, so this leads to an interesting question. And this is why, when this all comes to light, it could be scary. And I'll tell you a thesis I have that will be borne out. We'll see it. When I was doing equity investing for BlackRock in the stock, I'll just use the stock market as an example. 70% of the daily flow of funds in the stock market was done by fundamental investors, people who did research and whatnot. And it's always been thought the stock market is a good predictor of, a discounter of future economic activity. And so that going into the great financial crisis, that was what we had, 70% fundamental. Fast forward to today, it's 95% passive investing and algorithmic trading, only 5% fundamental. And a lot of the algorithms and passives, they just read headlines. So there is a chance that the stock market is so disconnected from reality that when it does figure out reality, it could happen faster than we could imagine. And I'm not predicting that, but that's kind of the scary outcome, is that everyone heads to the exits at once. Rather than in the great financial crisis, investors started figuring it out. So the stock market peaked in December of 2007 and started to go down, kind of stabilized, and then crashed. There were smart people who were figuring out what was coming. Right now, the stock market doesn't have really humans running the show.
Yeah, on the pricing side. A big part of the passive story is demographics too, right? So that the inflow of people saving for time and the outflow of people selling. This has been an extraordinary video. I don't know what to say. I don't know which part to put in the teaser at the beginning as the highlight. Incredible. Thanks very much for joining us, Ed.
Nikolai, thank you for having me on, and good being here today.
Hello and welcome to the segment of the video where we ask what it really means for you. And the thing that I want everyone to take away from this interview with Ed Dowd about a recession is that recession might be precisely the pin that pops the bubble of the AI Mag 7 stocks in the US that is so overvalued. That section of the stock market in the US has been outperforming for many years now. It's the reason why the US stock market has gone up as much as it has. And so if you're worried about a recession occurring, especially in the US, but also around the world, and you think that might pop the bubble, then you probably want to allocate some of your wealth out of those American Mag 7 stocks and into something else. We actually have a report out. It's free. You can download it by clicking the link in the description or pinned to the top of the comments section of this video. You'll get that report for free. You can download it just by providing your email address and nothing else. And it details the companies listed in the UK stock market that might take over the mantle from the American Mag 7. And so I think this might be where you want to shift your capital to, under the idea that the UK's version of the Mag 7 are in fact severely undervalued relative to the US market. And so you'd be much better off moving your capital there if you agree with Ed Dowd that a recession is coming. So do check out that link in the description or in the comments section below this video. Thanks for watching.